Welcome to Retire Mentorship. My name is Freeman Lindy. I'm a certified financial planner and enrolled agent, and I help retirees, people close to retirement, to make that transition and retire successfully and stay successfully retired. If you're retired or about to retire, you have probably heard of the 4% rule, which is, hey, you can take out 4% of your portfolio for life and never run out of money. So today we're going to talk about what is the 4% rule, how do we supercharge it so that we can get more out of it, and how do we help you make the most out of your retirement. So first, what is the 4% rule? Well, basically, this gets misinterpreted a lot. There's a couple of different versions of this. The main one, though, is that there was someone who decided to say, hey, what portfolio or how often would you run out of money if you took certain percentages out of your portfolio, right? And so basically what they said is they said, hey, let's take, right, if we have a long timeline here, let's take rolling, I think they were 30-year periods. Because if you retire at 60, live till 90, whatever, right? That kind of do it, right? So from here to here, from here to here, right? And like I think he did it monthly, like month end. So every 30 years, ending every month. And then he basically said, hey, what if you took out 7% per year? How often would you run out of money? Over what combination of ups and downs in the market over all these times, right? And went back over like 100 years or something. And basically said, hey, out of all these 30-year rolling periods, at what point, if you took out 7% a year, would you run out of money, right? And at 7% of the time, I don't remember what it was, but like maybe 50% of the time, you would run out of money if you tried taking out 7% per year, right? This is where some people will often kind of sort of misquote, sort of real quote. Dave Ramsey says, hey, a good growth stock return will do 12% per year, right? And so just invest in that, and then you can pull 8% a year out every year. And because if it goes up 12 and you pull out 8, that gives you 4% left for inflation. But that doesn't account for, right, the real ups and downs in the market. And so if you actually run it over what has been real time scenarios, maybe you don't run out. So don't quote me on the actual percentage of times you used to run out, but it was some non-zero number, right? And then he checked 6.5%, and then he checked 6, and then 5, and then 5.5, and then 4.5 or whatever. And then eventually, and it was like 4.2, 4.3 or something, is finally the lowest he had to go, where if you took 4.2% out per year, it was some decimal, it was definitely higher than 4 even. There was some decimal point where over that time frame, there was never a 30-year rolling time frame where you would have run out of money historically. That's where it actually comes from. There's a whole bunch of other versions of the 4% rule that are not true, or a different 4% rule, not the main one. But that's what it comes down to, right? Is, hey, if you took only 4% out per year, so if you have $1 million, right, going into retirement, you got $1 million, and you took out 4% per year, right? That's $40,000. This would be gross, right? Gross distributions, right? That there would never have been a time in history where you would have run out of money. Ever. Never has happened. Even through the Great Recession and 2001 followed by Great Recession, all these other things, right? There was no time frames where you would have run out of money. Now, what's interesting, right, is that if you go higher than this, there were plenty of times, like most of the time, you still wouldn't run out of money, and you would pull a lot more income, right? Because the difference between pulling 5% and 4% out a year, well, 5% is obviously 50 grand on $1 million. An extra 10 grand a year goes a long way towards enjoying retirement, doing fun, and all those other things. And for the times, if you only pulled the 4 out, well, during the other times when you didn't run out of money or get even close to it, a lot of times you'd end up with way, way more money than you started with, right? And for a lot of people, like they're so afraid of running out of money in retirement that they pull a small percentage out, and then their accounts get really big and they grow over the course of their 70s. By the time they're in their mid 70s, they have twice as much as they started with. But now you're in your 70s and you don't feel like spending as much. You get kind of past your go-go years, you're into your slow-go years, and then by then it's too late. So what we want to say is, hey, how do we supercharge this? How do we make sure that we can avoid we always talk about avoiding two outcomes, right? We want to avoid running out of money, right? Where we're in a race to find out, hey, what's going to run out first, our money or our time, right? And we don't want either of those to happen. We also want to avoid, how do we avoid being so afraid of this happening, right? That we don't spend enough and end up dying with a mattress stuffed full of money, a little bed there with some pillows, right? We just don't want to do that. right? So how do we enjoy the middle? How do we take our money and make sure that, yes, with the ups and downs of the markets and everything that's happening, that we end up somewhere in the middle, enjoying the money, but also never worrying about running out. Now, real quick, another common misperception, right, is because people in the insurance world actually love the 4% rule, right? So let's look at annuities versus the 4% rule, because what they'll say is, hey, 4% rule is that's the safe withdrawal rate, is another phrase that you may have heard of. That's where that comes from, right? Um, hey, if you invest in the market, right, then you can take out 4%, right? That's the safe withdrawal rule. And when I was working for an insurance-based firm, I would be in on meetings with retirees with my sales manager. And I actually heard him say it to multiple people. Hey, you've heard of the 4% rule, right? And other things I'm reading really make it seems like it's 3.5, more closer to 3% is the actual safe amount you can pull out, which is total BS. But he would say that because then he could pitch as normal investing, normal retirement investing, as being worse than the product he wanted to sell, which in this case was annuities. Because what they'll often say, right, is like, hey, you can get 4% in the market, or if you put it in this annuity, we'll guarantee you, guaranteed 5% withdrawal rate for life. Or if you put it in there and leave it for 5 years, you can get all these bonus step ups, right? And then we can give you 6% guaranteed for life. So, Mr. and Mrs. Client, would you like 4%, $40,000 a year for life? Or would you like $60,000 a year forever, guaranteed, right? And so it sounds pretty good when you pitch it against, other investment strategies. The problem is, though, right, that whatever that was. So if we talked about, 4% safe withdrawal rate, or a 5% annuity rate, or, wait 5 years, 6% if you did it all the way out here, right? The problem is that this was a flat income for life, right? Which is not okay when the cost of everything that you need and want to buy in life is going to double or triple. So if inflation, right, is growing at 3% and you have a fixed income of 50 grand a year, how nice is this 50 grand going to feel 20 years from now when the cost of everything is going to double? It's not going to feel good. It's going to feel like 25,000, right? And even if you wait for 6 years, yes, you can get a higher income guaranteed for life, but you also have 5 less years to live it, right? And so if you actually do the math on a lot of these annuities, you can basically, right? Because if you take $1 million and you're taking a flat 5%, you're taking a flat 50 grand out. How long will $1 million last taking a flat 50 grand out? 20 years. That's when you would run out at exactly zero. And so the problem is what they're basically doing is they're saying, hey, we're taking this at 62. There's a pretty good chance you're dead before 82 anyway. And we only need a little bit of interest to get out to 85, wherever you're going to probably live to. And so they're not really giving you a whole lot with that. And so just be careful of these people who like to pitch, a higher payout. There's a lot of this guaranteed 6%, guaranteed 7%, all these bonus, contribution bonuses and step ups and all that. And you can put your money in this product over here. And they usually won't even call it an annuity, right? They'll figure out some clever name to call it in their marketing schemes. And they'll feel like you get like a 7 or 8% guaranteed rate. What again, they don't tell you is that you have to lock it in for 8-10 years to get to that 8% rate. And by that time you're 70 years old. And of course you can pull out 8% a year if you don't even start until you're 70. And so, right, if you're buying annuities, there's a lot more hands in the cookie jar. A lot more people need to get paid, a lot more fees. How is it possible? If you just stop and think about it, right? If you have a lot more people getting paid out of your money, how is it possible that your money lasts longer? It's not. It's really that simple. And so 4% rule versus in annuities, not great. And the other thing that we look at then is because the 4% rule, when we look at 4% rule versus inflation, right, is that the whole point of this was, hey, it's 4% of your current balance for life. And so 4% is a low enough withdrawal rate that your balance keeps going up over time, right? And so if you take out 4%, let's say your account grows by 8% a year, right? And so you go to 1.08 million, and then you take out 4, and so now you're at 1.04 million, right? Well, now your balance is bigger, right? So if you take out 4% now of this larger number, your income goes up, right? And so that's actually where that came from. And it's 4% of an increasing number, which means that, yes, your income may be lower, but it's rising. And so what would you rather have? 50% flat income for life or 40% income growing with inflation, right? It's one of the stories I share in this book here, 3D Retirement Income, Where let's just say you had you had two job offers, and one was for, hey, we're going to pay you 50 grand a year. You're not allowed to leave the job for 7 years. We're never going to give you a raise. In fact, we're actually going to decrease your pay by 3% each year. And hopefully you'll still have something in 30 years. And the other one is, hey, we're going to only pay you 40 grand a year up front. And we can't guarantee any raises, but we've pretty much historically always given them, right? And there's no cap. You can leave anytime. And many people who have worked here have doubled their income within 7 years and then double it again in 7 years later, right? You would take the second job, right? Let's not be fooled by the upfront, this looks better, annuities, all that stuff. That's all that is, right? It's guaranteeing you a decrease in income for life because it is not keeping up with inflation. Sometimes they have inflation, right? Oh, hey, we do have an inflation rider, but it just lowers your payout, or you have to wait longer to do it. And again, if you just do the math, it's not great. Okay. Now, here's part of the other problem with just the normal. It's not really a problem, but this is where we can supercharge the normal 4% rule. Let's get some more paper here. There we go. Gotta have the sound effects. Okay, so the other thing with the 4% rule then is that some people don't really realize is if you look at how, like, what he used to concoct that, right? Is, let's do it down here. You got a normal portfolio, right? And the way that he tested this is he just did your basic, 40% fixed income, 60% equities, your average 60-40 portfolio, right? And he just ran that. He just ran it with like a total bond fund and a total stock market fund, just 60-40, just rebalancing annually or quarterly or something like that, right? So again, when we look at and so that was based on that portfolio. So there's no small caps, there's no mid caps, there's no difference in the types of bond funds. It was just always 60-40. When the market was up, it would pull stuff out of the stock market to invest it back in bonds. When the market was down, it would it kind of rebalance and do all this stuff. It's just not great. It's fine. It's what most people do. If you're fine with fine, if you're okay with being okay, then great, go for that. I guess fine, not great. But if you want to be great, if you want to supercharge the 4% rule, then I don't think we need to stick to this, right? And here's kind of the way that we do it instead, or the way that I teach. And this is not investment advice to you, right? I don't know you. Disclaimer is in the description, right? You can't come after us for teaching you this. This is just education. Talk to your financial advisor to see if this is right for you, or find one who knows what they're doing. So if we look at long term, right? Just again, timeline. There's really only two things we can invest in, right? And I'm gonna speed through this. I go through this slower with clients, but you can invest in fixed income, which is collectively anything that has a fixed interest rate on it, right? CDs, bonds, treasury bills, all those types of things, right? Those, depending on interest rates, have done, let's just call it 3 to 5%. Sometimes they're lower, sometimes they're higher, depends on what you're in exactly, etc. But pull the outliers in, that's probably about right. Or you have equities, right? Which are, ownership shares in the best business in the world, right? And we kind of talked about this a couple weeks ago, right? That we look at truly as ownership, and in the same way that your house doesn't lose value, you don't lose money on your house just because the value temporarily declines. The only way to really lose money is to turn a temporary decline into a permanent loss, right? So we kind of talked about that view of ownership versus buying stock, and so we invest in equities. And those, like the S&P 500, for example, about almost 100 years old, has averaged 8 to 12% calendar year returns. But it's only averaged that. It never does that. In fact, in like the 100-year history, 99-year history, the number of times that it has been between 8 and 12% is 4 times. That's it. Otherwise, it is, up 25, it's down 17, it's up to 35, it's, something like that over time, right? And if we invest in fixed income, those also can, fluctuate a little bit with, sometimes you have, 2022 where it goes way down, and then, it might do something like that, right? And so it'll go up, it'll fluctuate a little bit with interest rates, but it doesn't have as much of a wild pitch of equities, right? And so most people, they just say, hey, start with equities, right? When you're young, you want the growth, you can handle the ups and downs. But I hear this a lot, right? When you approach retirement, right? Let's say you're retiring here. You want to push more into fixed income. right? You want to accumulate and go up the mountain leading up to retirement, and then you want to decumulate and go down the mountain once you hit that finish line up there, and now you're retired, right? Which is obviously dumb. And again, if you're spending down your assets, now you're in that race again between what's going to run out first, my money or my time. I don't want to be in that race. And so this whole accumulate and then spend down is a dumb strategy. Just don't do it. And so, but they'll often say, hey, like rule of thumb, right? Something you can say in a 800-word blog post is invest heavily in equities when you're young, transition more and more to fixed income as you get older. And in the end, you want to be like 60-40, or there'll be things like 110 minus your age, right? So if you're 60, then the difference between that is 50, right? So at 60 years old, you should be 50% equities, 50% fixed income, right? So, and then when by the time you're 70, right, 110 minus 70 is 40, so you should be 40% equities, 60% fixed income, right? Stuff like that. So you can hear some of these rules of thumb as to how you should be allocated. And so the 4% rule took this normal 60-40, your standard portfolio there, to do that. And part of it is they want you to generate income from the fixed income. Okay, let's generate some interest income that you can spend every month, right? And then we want this for more long-term growth. You'll even see some strategies are like a certain bucket system where it's like, hey, we want something in here for short term, a different bucket of money for your midterm, and a different bucket of money for your long-term stuff, right? And so we're going to spend this one first over years 0 to 2, this one over 3 to 9, and this is going to be for 10 plus years, right? And then they just spend them down in this order, which is dumb for a different reason. Maybe we'll have time to get to that later. But so there's lots of different ways to do this, right? But the way that we teach it is, hey, this is where we get real growth, right? Because again, if inflation, normally I don't like to use green for inflation, but it's the only other color I have. If inflation is 3%, right? And the cost of everything you need and want to buy is going to double or triple during the course of your retirement, then your real return on fixed income is not 3 to 5. It's like 0 to 2, right? Your real return on equities is like, it's not 8 to 12, but it is 5 to 9, which is a lot better than 0 to 2. And so the only way to really get growth in retirement is to invest in equities, to be business owners in the best businesses in the world, right? And if you do it the normal way where you have fixed income to generate income, what you're saying is, hey, we want 40% of our money generating this. Let's call it 4% for easy math. And we want 60% of our money generating 10%. Let's call it 10% just for easy math, right? And I should have done the math on this earlier, but if you have 60% making 10 and 40% making 4, I don't know what that math is, but let's say it's like 6%. I don't really know. It's probably more than that. It's probably like 6.5 or something. I should have done that math. Right? And then you can pull out 4% per year, right? And then that leaves you 2.5% growth. And if inflation is not 3%, if it's only 2.5%, then great. It actually leaves enough room in your portfolio to sort of keep up with inflation. Maybe you'll spend it down a little bit, but it'll more or less keep up with that, right? We say instead, hey, it doesn't make sense to invest your life savings based on a percentage because you don't live based on percentages. You live based on dollar amounts, right? So my common example is like, where do you shop for groceries? Just think about that for a second. Like I shop at Walmart, get the Walmart pickup. When you got little kids like I do on this side, you don't want to go into the store. And so you do the Walmart pickup. And but let's say you go into the store, they check out all your groceries. Does the cashier look you in the eye and say that'll be 17.8% of your paycheck, please? No, they're going to give you a dollar amount because we live in dollar amounts. The only thing that uses percentages is the financial industry. Everybody else uses dollar amounts. And so it doesn't make sense to have a certain dollar amounts or a certain percent. It just breaks it down just by percentage, just on your age. It doesn't make any sense. So instead we say, hey, how much do you need to live? We want most of your money in equities, right? We're going to have a big bucket of equities. And that's where we're going to have most of your money because that's what's going to drive real growth, right? And 3 out of 4 years on average, the value of your companies is up. And so when they're up, you can just sell some off the top. Sell. Anytime you need income, you just sell some of that high and it's up 20%, you take off 5 and you're still up 15%, right? It's great. But sometimes the market's down, right? And so that's where we have our blue bucket, our safety bucket, where in the 1 out of 4 years, when the market's down, instead of taking money out of here, we knock that off and we take it out of our safety bucket instead. And we sell that down and we wait for the market to go down, come back. And once we're back to even, then we take it out of our red bucket again. And historically, every time we have a big downturn, it then goes on to make awesome new heights. And so we can always take some extra off that and refill up our blue bucket for next time. And so if we're thinking about it that way, rather than having fixed income to generate income at 3 to 5%, if instead we use it, hey, this is insurance money that's going to keep up with inflation. That's what this is, right? Well, then we don't need 40% of it in fixed income, right? Because if you have $1 million portfolio, right? Like you got 1 million bucks. Are you going to spend 40%, 400,000 over the next few years? I don't think so. You're just not going to. So why do we need 400,000 barely keeping up with inflation when you could have more making you money? Right? So the way that we do it, instead of a percent base, because that's not how we live on dollar amounts. We say, hey, how much do you need to withdraw from your accounts? Not your total expenses, because you'll have Social Security and maybe pension, those kind of things. But what's your withdrawal number, your target portfolio income? What do you need per year to live? And then we say, hey, let's take a certain amount of years and put that in the blue bucket. And we'd say, hey, you want at least 2 years going to retirement. 2 years will get you through most downturns. 2022 through 23 was 2 years exactly, almost 2 years in a week. Tariff tank was a few months. COVID was only like 6 months, 7 months. There's one in 2018 that was like 7 months. So that'll get you through most of them. But what if you have like a 2008? It goes down for a long time, takes 5 years to come back. And so we say, hey, you want 2 to 5 years of withdrawals set aside in your fixed income, your safety bucket, your blue bucket over here, and everything else goes into equities, right? And then if you reverse engineer the math, you're usually more like, 80-20 is usually how it ends up. We don't do it based on percentages, but if you reverse engineer it, that's where it is. So now, if you have an extra 20% of your money making 8 to 12 instead of 3 to 5, maybe now your aggregate return is 8% instead of 6.5 or whatever, right? Which means that now we can take 5% out per year and still have 3% to take care of inflation, right? You get your $1 million, it grows by 80,000. We pull out 50, and you've got $1.03 million left, which means you can take a higher number off the next year, right? There's a little bit more to it than that, but that's the gist of it, right? And so if we do that, we can, instead of just taking out 4% per year off of a 60-40 portfolio that we just invest automatically, or just have it in a robo-advisor or someone who doesn't really know how to do retirement distributions, so they just click the model portfolio based off a 5-minute risk tolerance questionnaire. Again, if you have all your money invested based on a 5-minute risk tolerance questionnaire that you filled out in a cozy office while the markets were at an all-time high, is that really how you should be investing your money? So instead, do the math, work with someone who knows what they're doing, and can kind of explain this, work this out. The problem with this strategy down here, this bucket strategy, is like you would do money market in this account, bonds in this account, equities in this account, and you would just let the equities ride, but then you'd spend on this, and then you spend on this, and but like you're not necessarily, like, the market may go down in the next 10 years, in the next 9 years, or it may be way up. And so you shouldn't just spend them down based on some order. You should be spending based on what the market's actually doing in real time, right? Which is really hard to model because we don't know what the market's going to do in advance. But this way you're prepared for the ups, you're prepared for the downs, and you can supercharge your withdrawals and should be able to take closer to 5% out. And especially if you're going to be flexible with it, you can take higher amounts in good years. And as long as you can back off and go to a local vacation instead of Hawaii once in a while, you can get more overall, and that helps us enjoy our retirement more while we have the youth and energy to do it without risking running out of money in the long term. So that is how we supercharge the 4% rule with our clients, getting much closer to the 5% for their target portfolio income. Right, this is what we want you to take each year. It's your job to enjoy it. It's our job to manage the ups and downs. How is this invested in here? How are these invested in here to make the most out of these ones, each of those? What about taxes, traditional versus Roth versus brokerage, all these other things? How does all that manage? That's what we're here for. So if you want help implementing this, I think there's probably gonna be a link in the description somewhere. You could schedule a welcome call, introductory call with me. And then lastly, right, this book's coming out for sale in 3 weeks. You can pre-order it now. Links in the description to pre-order it. As a thank you for pre-ordering it, we're going to send you this one in all formats. And we talk a lot more about all of this, red bucket, blue bucket, and the bigger strategy, right? What I just covered with you in 20 minutes, this takes about 6 hours of audio to go through. So a lot more to learn. We want to give all this to you for free. You can get any and all information for free anyway. We just like to curate it and give you the better information for free. And then if you need help implementing it, that's what we're here for. So hopefully that was helpful. Get more out of retirement, enjoy it more. And it's time for questions. If you want to, we do this live every Wednesday, 4 p.m. Central, right? So you can tune in there. You can throw questions in the chat, and we'll try to answer them live on the show. And so that'll always be fun. It's always fun to, right? Anyone can rehearse something. I don't rehearse a ton for this, but I do a little bit of stuff so I can, know what I'm going to say. But it's really fun to get like super live questions that I've had no time to think about. Otherwise, we'll always answer email questions that you email into us. So you can email questions@retirementorship.com. And so we're gonna do one of those now here. And this one I had like a second to look at, and so I pulled up a couple things that we'll show you. But the question, we can throw that up there. I got producer Ethan over here trying to run the show. Lorraine had asked, what is your opinion on investing in gold? Gold's a hot topic right now, right? Everybody wants to be in gold or wishes they had been in gold because it's up a bunch, like a lot. So I'll show you this chart here. We've got the let's just look at the last 10 years, right? So gold over the last 10 years. Actually, let's look at this chart up here. Historical chart, right? Yeah, like 10 years ago, it was $1,000 an ounce. It's up like 5x, right? 50 something, 5,000 something right now. I think it's down a little bit, but it's still pretty close. And so that's awesome, right? A 5x return over 10 years is just awesome. And so everyone's like, should we be investing in gold? What do you think about investing in gold? All those things, which is I just want to first say it's a very normal thing to do, right? Most people see something's going well and they're like, should we be in on this? It's called euphoria or buying high, right? We always want to be in something after it's gotten way up. So I want to give you a little bit of context for this. So first of all, what's my opinion on investing in gold? Number one, I guess, gold is not an investment. So you can buy gold. In my opinion, you can't invest in gold, right? It's a little bit semantics, but the real things you invest in future cash flows. That's what an investment is. If you buy a bond, you are buying a bond because it is now going to pay you interest payments for a set amount of time, and then you get your money back. Right? If you buy a CD, it's going to build up interest inside of there, and then you're going to get your money back plus that interest. Right? If you buy a business, like either in the stock market, you're buying an ETF full of businesses or Apple stock or whatever else, you are buying the future cash flows of that business. Right? I'm going to put $1,000 into this business, and I expect that they are going to generate profits that I now get as the owner over time, and then eventually hopefully can also sell that share to someone else, and it'll be worth more when we paid for it. And so just, I'm what I call an equity evangelist, right? I share the good news of owning the best business in the world. And so, right, when you invest in equities, right, there's two ways you make money. One is the dividends, the profits that you get as an owner, right? And the other one is appreciation, which is the businesses get better, right? They were worth more than when you paid for them, right? When you buy gold, there's no number one. Just doesn't, like, there's no interest income, there's no profits paid out, there's no cash flows. You just buy it, and you buy it at one number, and you hope that later someone else will pay a bigger number for that, right? It's called it's not so much for gold. People don't use this a lot for gold, but they'll use this a lot for other speculative things you can buy, right? So it's called the greater fool's strategy, right? Where, hey, I'm going to buy this, and I hope sometime down the road, someone else will be a bigger fool than I am and will buy it from me at a higher price. But gold doesn't produce anything. It doesn't treat any diseases. It doesn't solve any problems in people's lives. It doesn't earn any money. It doesn't it's not an investment like anything else that we would invest in. It's a commodity, right? That's what it is. It's a hunk of metal, or it's a ETF that owns a bunch of hunks of metal, right? And so I'm not saying that no one should ever have it. It's just not really an investment, right? So here's some context, because I think investing is always good in context. So if we go back to these charts over here, right? Over the last 10 years, it's been awesome. And if we look at the 50-year history of gold, right? We can actually look all time, right? So it was really stable for a long time, gold standard and all that, went away, and then it spiked way up, right? So we're gonna miss a lot of this growth here from I guess I can just slide this over. Look at that, what a dream, right? So from like 1970, it went from $35 an ounce to 670, I think is where it peaked, somewhere in there, which is like, I don't know what kind of X return that is. It's incredible, right? Let's just look at the last 50 years. We'll zoom in a little bit, right? So peaks way up at 670, I think. There we go, 670, right? And then it went down, and it just kind of hovered around for a long time. And it took until, here we go, where is it, right? Somewhere in here, right? There's 678, 2007. So from 1980 to 2007, for 27 years, that's how long it took to break even from its prior high, whatever amount, right? 27 years. If you look at inflation, ooh, that was fancy. If you look at inflation, right? Let's look at 50 years with inflation, right? So now inflation dollars, right? This would be 2,700. And here's your 2007. You're actually still way down. And you almost caught up here, because again, it was 2792. And we have to go all the way until 20, somewhere in here. We'll just give it right there. Last year, October 22 years ago, a year and a half ago, October 2024, for you to catch up with inflation. So 1980 to 2024, it's 44 years to actually make any real money if you had bought it back at the peak in 1980, right? Which is incredible. And so it's not great. The thing about let me actually, can I share? I think I can switch this. Stop that one, and then let me share. I like to use I have big fancy tools. I like to use tools that you guys can use, that anyone can use, and show things on here. So let's go. You can throw that one up there. Let's even just look at the last 10 years, right? So if we look at the S&P 500 over the last 10 years, it's just like Apple's stocks app. You have it on your phone. You have it on, if you have a Mac, you have it on your Mac. So we can see that over the last 10 years, the S&P 500 is up 243%, which is awesome, actually. And then the gold ETF over the same 10 years is up 291, right? And so again, you're up. Gold has done better than equities over the last 10 years, right? Or so it seems, right? But again, if we go back to our other charts over here, or our things, real, the investments, right? Equities go up and down. They go up in value, but they also pay a dividend. It's usually a percentage of their value. And so as the value goes up, the dividend payments also go up, your dividend income. And these two things together, 1 and 2, are called your total return. And ultimately, that's all we should care about. Total return, both of these things put together. Or in this case, just the one, just the value going up. Because again, it doesn't pay anything, right? And so a lot of times we can look at things like this and we say, oh man, gold has really crushed the S&P 500 over the last 10 years. And it's just not true. Let's go back and look at, let me stop this one. We'll go back to our other, I can only share one screen share thing at a time. Let's go back to here. So here's another one. I actually like this one a lot. Don't quit your day job is what this stands for. But they have an S&P 500 return with dividend reinvested, right? So if we look at even the last 30 years, we're looking at 30 years of inflation, or 30 years of retirement, right? From March of 96 to March of 2026, the S&P 500 is, actually, let's do 10 years first real quick. I think I have that right here. So same 10 years, 2016 to 2026, there's your same 240%, right? This is like month-end returns. So it's going to be slightly different than the Apple Stocks app, which shows 243, right? But, so a 13% annualized rate of return, which is awesome, by the way, and not to be expected. But the total return, if you reinvest those dividends, is 300%, right? So we're still up over the 291 that gold is over the last 10 years, right? But here's the other thing, right? So if you look over the last 30 years, you're up, 10% on average. This again, if you look at most 30-year returns, S&P 500 just kind of averages out to 10% with dividends reinvested, total return, right? Gold over that same 30 years, 96 to 2026, about 8.8. Okay, so less, but still pretty good. If we adjust these, let's take, where's my keyboard? It's way over here. Let's take from 94. Let's just back off 2 years. Now your total return, your annualized return is 5.8% in gold. Right? If we come back over here to the S&P 500 and we back this one off by 2 years, total return still about 10%. Right? Because here's the deal. Right? Again, if we look at this, most of this return is just in the last couple of years here. It's going crazy because people are worried about other things. Just like there's a few other stretches in history. This is the inflation adjusted one, right? A few other times in history where it went crazy. And if you were one of the people that, hey, it's going crazy, I want to invest here. Great. 27 years before you break even nominally and 44 years before you break even with inflation. Do we want to do that? Do you want to buy gold now? Maybe it'll keep going up, right? Maybe we are here in the cycle, right? Maybe it will dip and then maybe it'll still double or triple or whatever again. I don't know, right? Nobody does. But there's also the chance that because it doesn't produce anything, it's only worth what someone else is willing to pay for it, that now is the peak right here, and it's going to be 44 more years before it breaks even with inflation again. Is that how you want to invest? And so here's if we go back to our chart, right? Here's how we invest. If your money is on the line, your retirement, all those things, invest in things that I don't know how to write this out really easily, but invest in things that always work. Always work. Investing in the S&P 500, investing in equities, and best business in the world has always worked. Right? We just talked about it in the earlier segment. You can pull 5% a year, more sometimes, whatever else, and over almost all 30-year periods is averaging 10%. There's a way to pull it depending on what the market's doing, ways to make that very secure. And it always works. If you're investing in things like gold, which usually don't work, and then occasionally have these big spikes, right? Well, you can't hold that for 30 years, or you shouldn't, because most of the time when you hold that for 30 years, you're looking at a 4 or 5% return or a negative return, depending on when you bought it for a super long time. So again, do we want to invest in gold with a 5% rate of return, or do we that may be negative for a long time, may take 44 years to break even, may do all these other things, or do you want to invest in something that has a very strong historical average of 10% over long periods of time? Right? You tell me. I want to do things that always work, because if you're trying to invest in things that only sometimes work, then you have to time it. And when you time things, right, you have to be right twice. You have to be right when you get in and when you get out. And if you're wrong on one of those things, let's say you get in here instead, and then you get out there, well, now you're wrong both times, right? Maybe you get in here, and you were right on the way in, but you didn't get out, and then you didn't get out again until here. And maybe if you made some money, you made 3% over that time, which wasn't that great, right? So when you're trying to time things, whether it's trying to time the market or trying to time a specific thing, you have to be right both times, when you get in and when you get out. And unless you're really good at that, which nobody is, by the way, I wouldn't try it. And so we always say, like, hey, with the majority of your money, the money you need to live on, you should always invest in a strategy that always works, which we just kind of covered. Red bucket, blue bucket. That's what we teach in here. This strategy historically has always worked. And when you do that, it creates more tax issues because you've got a bunch more money, which is why you will need this book. And if you're watching this, because we'll probably clip this and make it a separate "Should I Invest in Gold" video. It was go back to our channel. There's another video that we made that I was just referring to. So that's what I think about investing in gold. It's not an investment. We should invest in things that always work. If you have side money, right? Hey, I got enough to live on. We have extra money. I want to play around with it. I want to try single stocks. I want to try Bitcoin. I want to try gold, whatever. Great. If you bought gold back in 2024, good for you. Awesome. It's the same thing for people who bought Bitcoin before it went crazy, before people who bought Amazon, Apple before they went crazy. There's plenty of examples of people who bought at the right time and got lucky, that's just not necessarily repeatable. And so if we're looking forward, and there are no facts about the future, we want to invest in things that we know have always worked. So hopefully that's helpful. That's what I think about investing in gold. If you have extra money, knock yourself out. If it's what your life savings is depending on, I don't know that I'd buy high. You know, not sure that that's when I want to do that. But again, this is not investment advice because I don't know who's watching this. So if you want investment advice, then you can come talk to us. But hopefully that's helpful. We'll be back here next Wednesday live on our YouTube channel here. Throw us a like and subscribe if you want more content like this. Otherwise, we will see you next week. Cheers.